Well, I think you saw this slide. Here, why don't I take that?
Sure.
Mitchell stole my first slide about, it wasn't so much who people thought were going to win the election, but which candidate was best for the deal environment. And so, as Mitchell said, now President Trump won that. But I thought what we would do is ask some questions about what you all think about the deal environment. And it's very timely because last week, the Tulane University Law School, I'm sorry to the Richmond Center in Columbia for plugging Tulane, but they have one of the preeminent M&A forums really in the business. And last year, last week it took place, and we surveyed deal makers, about 120 deal makers, mostly from North America. So it was more of a domestic U.S. audience about their views about the deal environment. So we thought it would be interesting to ask the same questions of this crowd and then see how it compares with the survey results that we released last week ahead of the Tulane conference. So the first question, very basic, compared to the level of deal activity in 2016, what do you expect to happen to the level of M&A in 17? So please use your apps to see the results. Let's see. Okay. We have a pretty bullish crowd here. That's great. It's a nice spring day in New York. We should be bullish. So you all think that roughly about 60% expect that the level of M&A activity will increase. That is actually more bullish. Now let's look at the Tulane, the Brunswick survey, about 44%. So actually this is a more bullish crowd, which is interesting. Next question is, what do you expect the overall impact of the Trump administration to be on M&A and deal making? Positive, negative, neutral. So let's go to the apps. $46, $48, $49. Okay, actually, that is, I think, oh, sorry about that. Sorry about that. Pretty much identical. So nearly half expect that the Trump administration will be positive for the M&A market. And I think you're seeing that in the overall levels of the equity markets and access to capital. Just a couple of other themes that came out of our survey. What types of deals do you expect to drive the M&A market in 17? And you know, it's interesting because Mitchell talked about the growth of cross-border M&A. I think there's real concern among U.S. deal makers that because of the rhetoric around China and the president's comments that you're going to see more scrutiny of inbound deals, and I think that this reflects that, as you see in the second section, the second part of the slide. Sorry, let me just rephrase that. The first one, more people expect domestic transactions, fewer cross-border. The next question was really, do you expect the level of antitrust scrutiny for deals to increase or decrease? I think not surprisingly, people think that, as many of you may know, the administration recently appointed a new head of the antitrust department at Justice Department. So most people clearly expect that there's going to be fewer antitrust challenges as compared to the Obama administration. Just a couple of other themes to set up the conversation. Again, most people expect domestic transactions, fewer cross borders. And then couple of other points. So what are the changes affecting M&A activity? Clearly, corporate tax reform and repatriation is a big positive. Another one, as we just talked about, is antitrust and as I said, repatriation. But interestingly, top considerations for companies making an M&A decision. So, we all, working with financial advisors, help craft the story, the equity story, and synergies are always a big part of the story. And Wall Street wants to know what the annual cost synergies are going to be, capitalize and put a valuation on it, get a number, and really sort of hype the synergies. Well, interestingly, in this political climate, and we're seeing this in our business already, companies are quite concerned about going too aggressively, announcing cost synergies, announcing job cuts, closing headquarters, closing plants. And in fact, what is interesting from this survey and we sort of prompted this, of course, is that companies are going to have to think long and hard about what their job story is, not just about their synergy stories. And so this came up at Tulane last week, but also it came up clearly in the survey that as we're planning mergers and acquisitions announcements and the communications around these transactions, we're going to be asking of our clients, okay, yeah, I know you want to talk about synergies, but in an era where a presidential tweet could impact your stock price and perhaps your license to operate, you need to be thinking much more proactively about the job story. So that was, I think, another important theme that came out of Tulane. A few other things I would mention as I pass the baton to Bruce about other themes from the conference. Mitchell alluded to it, convergence. That was clearly a theme in terms of expectations for 17 and 18. A couple of other themes. The head of M&A at JP Morgan, sorry about giving them a plug, guys, basically got up on stage and said that he thinks a $100 billion cash deal is financeable. He got up and he said it, and then halfway through he said it again, and then at the end he said it again. So I think the message from JP Morgan is, I think Jamie Dimon must have told him, hey, the message is we can do a $100 billion cash deal. Convergence, other themes. Again, general sense of optimism, but absolutely concerned about the political environment as well. Bruce?
Well, thank you. We've got some slides to level set, and maybe we asked the questions before we gave people the background, which probably wasn't fair. So I'm going to do this literally in 2 minutes, not spend a lot of time on the slides, and then we'll have a conversation up here and open it up for questions if that works, and we'll try to hit some of the themes of the conference. This first slide is just a 20-year view of the M&A market. You can see the cyclicality. It moves with, this happens to be the market caps. It moves with CEO confidence, consumer confidence, pretty correlated, extrapolates on the upside and extrapolates on the downside based on confidence. You can see the last 3 years that were mentioned, 14 to 16, a lot of activity in M&A. The orange is meant to be inversions and China outbound, both of which really are under pressure. So we tried to look at activity in the blue bar, anticipating this question of what is 2017 going to look like. So you can see 15 was a little bit, much higher than where we are now, but 14 and 16 are about the same. We'll get to the question of where does 17 look, and we'll ask everyone on the panel. You can see in this chart, this just is $10 billion plus deals. You can see how 2015 just had a spate of mega deals, and in the box below, you can see the $50 billion plus deals. And so that's really what drove 15. You had these mega deals. The interesting question, and it seems like Mitchell just stole every slide that we had planned to use. So the message is don't send anything to Mitchell ahead of time. This is withdrawn activity, which there was a lot of it. So the actual, my view is 14 through 16, the activity was even greater than is shown on those charts because of the tax law changes, Brexit, the antitrust environment that we were in 15, 16, a lot of withdrawn deals. I had a little bit of a different view than this slide that was up before. The technology was driving everything. our experience, I don't know, Avi, if you feel the same way, it's been pretty broad-based across every sector over the last 5 to 10 years. At the time of the internet bubble, that was the last time we really saw.
Yeah, and in fact, I would agree with that. And when we have seen spikes, if you look at the activity last year or this year, healthcare is much more muted. Technology is up. But when you look at it on a 2 or 3 year basis, as you have here, it's actually very broad-based. One of the reasons we've had confidence in the M&A market is that we felt that the level of activity was grounded and very diversified. When we start seeing spikes in certain sectors, that's often a time of toppiness and cause for concern.
Okay, perfect. Let's see. This goes to the cross-border question that was raised. Again, about half the deals are in the Americas, split pretty evenly, Asia and Europe. That Asia number is a lot bigger than it would have been 15 years ago. It would have been a microcosm of that. And then you can see on the right-hand side, again, this idea about China outbounds and tax-advantaged M&A having driven a lot of that activity in 16. So the real question is, you look at the bottom right, is what does activity going into 17 look like? It's up year over year, first quarter 17 versus first quarter 16. But first quarter 16 last year was a disaster in the markets and a lot of volatility. So tough to tell based on that. Now we're going to get into this last quarter. Mitchell had sent me an article driving me nuts trying to figure out some data for him ahead of the conference. Why is first quarter activity up so dramatically? What trend is going on? Looked at it a little bit more, and if you really analyze what happened in the first quarter of 17, there's 2 buckets in there, or there's a big bucket in there, which is the impending Trump tax law changes, at least is our view, where with offshore cash. And there's been a trend over the last 5 years, 10 years, for companies to use offshore cash to use M&A deals because they don't want to repatriate the cash back. It's a lot more efficient, and the cost of capital on that cash is close to nothing. So we've seen that trend, but recently, if the tax law changes, and there is some amount of tax on repatriating that one-time repatriation, it's more tax efficient to use that cash now. There were 2 big deals in the first quarter, which were probably 40% of the volume in the first quarter, which were done with pure offshore cash. So don't know if that's a trend or not. The other thing is people say, well, the exchange rates have really driven the recent quarter. The strengthening in the dollar in terms of U.S. outbound occurred, well before this last quarter. I mean, it's bumping around, but you could see that happened really, in 15 is when the strengthening of the dollar occurred. And then finally, where is M&A trending? This is a quarterly view. You can see the volatility in 16, and you can see the first quarter of 17 is up versus first quarter 16, but down. I can't read the number, but it's down a big number versus the fourth quarter of 16. So if you ask my view of the chart, I got 2 more slides, and then I'll give you my view. This is a chart that I call the M&A Affordability Index. It's the PE of the market versus the cost of borrowing. And you know that over the last 5 to 10 years, we've had, I would say, abnormally priced credit markets, which make it, almost, it's so inexpensive to borrow and to do transactions that every deal is accretive. And this just does the difference between the PE of the market and the cost of cash. And you can see that the affordability index was at monster highs over the last few years. It's ticked down now recently. I don't know what that means in terms of going forward, but I know Valerie and I were talking ahead of time, and you made the comment that, what was the word you used? Very choppy, pricey?
Frothy.
Frothy.
That's the word I used, yeah.
And from a corporate perspective, I would echo that. I think people think that the market right now is really frothy and almost too expensive to some degree. You'll continue to see M&A, but it is expensive, so I think that will hold back some activity. And then finally, we said, this idea about tax reform, Mitchell wanted us to talk about that. Did a chart here showing what the benefit to different credit ratings, and higher investment grade companies will do better in terms of earnings under the potential tax reform. Green is good, red is bad. And then what we tried to say, is it priced in? We took one of the Dow 30 companies, we changed the numbers, didn't tell you who it is. And it says that if you take their pre-election share price and compare it to today, and you actually quantified each of the potential tax changes that people are talking about, you could argue that the stock went up almost exactly, quantifying in all the potential tax changes. So you could argue that the potential tax changes are already priced into this frothy market we had. With that, those are our slides, and then I thought we would have a conversation. My view on the question was, I'm neutral to slightly negative on 2017 outlook. I don't know. Maybe that's a good question to, why don't we each give our answer, and then we'll go into some fun questions.
Go ahead.
Yeah, sure. I would echo the remarks on the macro environment. If you take a step back, obviously, you have rising interest rates. You have relatively high record equity valuations. And in addition to that, and this is one point that hadn't been made, it's Blackstone's view that corporate profit margins are likely going to come under pressure. If you look at commodity prices, they're increasing, wages are increasing, and obviously the interest expense is increasing. So in this macro environment, it is more challenging to set up new transactions. And so you have to be selective. I would agree with the thoughts on what is driving M&A with the addition of technology in this.
I would be neutral to slightly positive, and I would distill it down to two basic factors. I do think that the interest rate environment is going to rise, but I think it's going to rise more slowly. I think Bruce's affordability index chart is going to remain relatively elevated when you put a wide lens on it. And the second is that I think growth is going to be hard to come by. And when growth is difficult, companies really have a choice in terms of how they're going to grow. If they can't grow organically, they will look to M&A to do so. The cash repatriation introduces yet another wild card that could fuel further M&A. So I would say that there are a lot of risks on the horizon. We'll talk about that as we get through more comments on the panel, but I'm neutral to slightly positive from where we sit today.
I'd stay with neutral, I use the term frothy. We're seeing some strange things that we haven't seen since probably 2007, 2008. The other day we received a package as a teaser. It was packaged as though somebody was selling an Hermes scarf. And for a company that has 20 million in revenues, and I mean billion with an M, being sold by a major bank in a package, they must have spent $1 million on the marketing material for something which is a consumer good. You're not going to be pricing that up in the kinds of margins you'd see it in tech. When we start to see that kind of thing happening, you know things are a little out of control. It's just expectation of, and people have visions of sugar plums dancing in their heads, which is nice, but I don't think we'll play under those circumstances. You just can't extract value.
I'm the PR guy. I should probably be more upbeat, but what I would say is, I mean, I'm bad at forecasting M&A trends. I was asked about this right before the election. I said, it's going to be very quiet until after the election, and then AT&T announced an acquisition of Time Warner the next day, and BAT announced the acquisition of Reynolds American. What I would say is that I think people are just trying to figure out the economics and the politics. If tax reform comes, obviously that's a big benefit, but when will it come? Most likely 18. Will it be retroactive? All these things have created a good bit of uncertainty. Generally speaking, if you look statistically, and academic literature says rising equity markets mean the M&A business is going to follow, and combine that with a pretty good sense of CEO confidence. So I would say you've got a lot of positive forces at work. But in looking at our practice, it definitely feels very choppy, a little quiet right now. But it does feel like a lot of forces are in play for a pretty positive 18.
Okay. Well, the good news is I have 22 devices, and we have the questions coming in, and I don't know if I'll figure this all out. But one good question came in about the M&A landscape in tech and fintech, and I thought maybe Martin, given you're our resident expert on the panel, maybe you could lead us there, and then we'll all join in.
Yeah, so there's obviously a lot of activity in fintech. Tends to be more on the VC growth equity side. Fintech is actually a term that's rather ill-defined. If you think about it, it is peer-to-peer lending. It is financial technology for financial institutions. It is Bitcoin. It is blockchain. So it is a term that's used almost indiscriminately. It's payment technology, Apple Pay, whatever you think about. These things have very little to do with each other, but they're revolutionizing areas. We've actually spent a lot of time last year at Blackstone thinking about which one of these are going to be most transformative, and our conclusion is similar to what was being previously discussed here. We think the blockchain is a truly transformative technology. Some of the other fintech areas are a little bit more hyped. In terms of technology, looking backward about 2 or 3 years ago, the trends that we focused on were, when we looked at trends that have legs for 10 years in the larger M&A environment that a buyout fund such as ours would invest in. And the areas were effectively the cloud, cyber security, and SaaS. The cloud of those is a hugely transformative change, in effect, making computing power a utility that is so cheaply produced by the utility that you cannot produce it at the same cost at home. So an analogy would be a power plant versus running your own diesel generator in your home. Nobody would do that anymore other than for backup. And that transformation is still in its early innings. Most companies still run their own data centers, have private clouds, and so we think that's going to continue. And we see it when we talk to, for example, banks, which were extremely concerned on putting anything in the public cloud, and that's shifting very rapidly. With that comes software that is being delivered as a service, which drove a lot of M&A activity by buyout firms, and then cybersecurity, naturally, as everybody knows. Now, valuations in these sectors are highly elevated. And if you look at buyout firms such as ours, there wasn't a software company in application software that didn't, in a size that a buyout firm could do, that didn't see multiple bids. And multiples in these sectors have been driven up. So if you look at the deal activity in 2017 year to date, there's much less software M&A activity for buyout firms. The pipelines are skinnier. And so valuations, as per the previous comment, has put a bit of a damper on our ability to set up new transactions.
You have any comments? And also, if you wouldn't mind, I think one other thing, in addition to fintech, if people have any comments, because I'm looking at some questions, also how, and came up in the earlier session, how tech impacts other sectors as well, which typically when we talk about tech only, but if you can maybe address other sectors, that'd be good.
Yeah, I'll actually address the broader tech phenomenon. I mean, the way we see it, and tying back to some of the comments that Tom Wheeler made, is that we've seen an enormous concentration of not just information, but now what's turning into intelligence and therefore market power in the hands of 5 real significant companies now in Silicon Valley. So if you take Amazon, Microsoft, Alphabet, Facebook, and Apple, these 5 have now put themselves in a position where the amount of market intelligence they have on audience members or consumers or clients, however you want to frame it, is enormous. And I think what's happened is that they have realized that they don't really need to buy a lot of companies, a lot of startup-y type companies, in order to propagate that power. They feel that they have it concentrated already. That's having implications on how we think about M&A across the tech landscape. It's starting to have implications, although we're at an early stage, in how VCs think about what next e-commerce and internet startups they're going to fund. And I think that there's an enormous scale and compounding effect that continues to build with these 5 companies. And I think that, one of the things we looked at recently was, if you look just at the consumer internet alone over the last couple of years, 9 of the 11 deals that were done in that space, the buyers in 9 of those 11 deals were non-internet companies. And I think that the disruptive power of what's happening here, and it applies, I think, to fintech as well, is that it changes incumbency status. And when incumbency status changes, people who are not in the fold of what's growing, not in the fold of what's new, look to M&A and look for acquisitions to try to get a place over there. And that's why you can see that companies like Yahoo were purchased by non-traditional players. It remains to be seen what will happen around the rumors around Twitter. But I think it's notable that both in the case of Yahoo and Twitter, these big 5 did not feel the need to buy that audience, buy that network, buy that information, buy that data that it represented.
I'll take a more sort of story-based approach to this because we're in the industry. And we look at data and we look at the interconnection and we look at this concept of being pushed down. the VCA deal that we're in the process of trying to close. One of the reasons behind that is
Well, could you just explain to people what
Yeah, VCA is a veterinary practices business. It has over close to 1,000 practices, and it also has a lab business. But what's interesting about that, and we're already also in the veterinary space, which most people don't know, but we are in the US. And one of the things that's interesting about this is we have a mantra, which is to make a better world for pets. And even if you do start to look like your pet, as was demonstrated earlier, pet ownership has an inevitable sad end, and that for people is difficult. So trying to change the approach of veterinary science to, rather than a fixed model, to a treat beforehand, to a preventative rather than wait for the disease to happen, you can actually retard as much as possible. You can delay the bad health of the animal, and you can actually keep on top of its good health. But the way that you do that is by being connected. So it's everything from the connectivity of the owner to the vet, being able to access the vet when they need the vet, with it's by electronically, or being able to access them. So you still have to take your animal to the vet, but how much of it can you start to do by connection? And it goes to connection. There's a tracker, there's a Fitbit for pets called Whistle, which we also bought, yeah. And the thing about it is that it allows you to actually identify how much activity your pet is having. So if your pet is getting a little bit fat, your vet might just say, well, what are you feeding your pet? Well, I'm feeding him this much. We always underestimate what we feed our pets. But the same thing, you can have a Whistle tracker, and you can actually give that tracking information to your vet. You might actually be able to transmit it. I know somebody in our business who tracks the animal's activity, whether the children have actually been taking the animal for a walk. He can look on his app, on his phone, and call home and say, hey guys, you haven't taken the dog for a long enough walk, which is pretty funny. But it's that kind of connectivity. It's the sharing of data which can make pet ownership that much easier. When I start to look at that and the possibilities, it's hard to stop in terms of ideas of kinds of businesses that could be created. Because when you link that and you make it a better world for pets, you make a better world for humans, but it's all about the connectivity. Otherwise, it doesn't work.
Steve, do you have any comments?
Well, I was going to give some broad-based answer, but instead I'll give a funny anecdote. Last week at the conference, somebody showed me, to the Pet Point, an app called, I think it's called WAG or WAGs, and basically it's Uber for pets, okay? So if you're a busy lawyer in Midtown, it's an app that has GPS, okay? And you could see when your dog walker is walking your dog, how long they have walked, and then, of course, there's an emoji for if and when your dog does whatever it needs to do, and you get that email to you. What will they think of next? On a more serious note, what I find interesting is in this convergence world, so you had AT&T announce acquisition of Time Warner. You have Verizon, they bought AOL. And then they are closing in on the acquisition of the core Yahoo business. I don't know if anybody saw this week, they announced the new name for this combined company, which is Oath. And on Twitter, there was a lot of funny memes, but on Twitter, it was more like oof. And all these large companies are trying to figure out what to do. And so what does Comcast do now? What do the big cable companies do? I don't think they're gonna sit still. I think there's gonna be a lot of activity. Not that they're all gonna go in the same direction. Clearly, AT&T and Verizon, with their core business or core wireless businesses under pressure, are finding that they need to go deep in media. And I think you're gonna see more interesting versions of that kind of approach.
I'll make one last comment on this, and then we'll probably go to one-off type questions, and I'm going to try to answer some of the, direct some of the questions from the audience. Last thing, just thinking about a lot of the comments that were made before, and just because Steve, myself, and Avi worked on this deal together, everyone thinks about tech and the impact of technology on M&A. They think about tech and fintech. You know, in a more pedestrian world, the three of us worked on the Marriott Starwood transaction. If you really step back, not that it was the key driver, but one of the most important drivers of that was actually technology. And how do you know, and what's the disruption that's occurring in terms of information, the internet, Airbnb, the online travel exchanges, you know, how does a company like Marriott compete in that world going forward? One of those was to have the destination product suite that nobody else really could compete with. So they were delivering to their consumer, and on top of that, Starwood had obviously a terrific loyalty and you know, web-based programs. I think I'd say every deal that I've been working on in kind of your more, to your point, just kind of more mundane industries, the impact of technology and how you're going to deal with that going forward is one of the top 3 or 4 items that do get discussed, even if it's not directly kind of cool technology.
Yeah.
So with that, there's been about 8 questions revolving around you know, Brexit, Europe, nationalism, impact on cross-border. I'm summarizing all of them. I don't know, does anybody want to take that one?
I'd almost rephrase it because we have a very international audience here, and I'd like to tee up this question about Chinese acquisitions in the U.S. and between CFIUS and the halls of Congress, whether A, there are going to be, is it going to be much tougher to get through the political and CFIUS process, and whether that in turn will dissuade Chinese buyers from even trying. And I don't have the answer, but I'd sort of like to tee it up. Maybe Avi could take that.
You know, I can start. One of the things that we observe is, in addition to the deals that are printed and announced that we can all talk about in this room, you know, we've got an inventory of things that we're working on at any moment in time. And I would say that there is a profile to that inventory, if you will, that really hasn't changed. In fact, it's gotten more ambitious in terms of CEOs and boards going after really dream deals and really aggressive deals, deals that require you know, possibly the outer edge of the financing that's available in the markets today. But the second, to Steve's point, is that we really have not seen at least the inbound capital throttle back yet. I think they're cautious about what's going to happen to the first couple of deals that they may announce in this new administration and in this new environment, but we certainly haven't seen their ambitions curtail back. And I think there's some broader macroeconomic reasons that are centered around what's happening in China and what's going to potentially happen going forward in China that are driving that. But our sense is that the Chinese bid is still very real. It's still very relevant. And even in the deal that Bruce cited with Starwood and Marriott, Anbang, that came in and tried to interlope that deal after it was announced, ultimately was not successful. But they did change the dynamics. Marriott did have to pay more to preserve that deal with Starwood. And so I think even when a Chinese bidder may not be successful in the ultimate transaction, they do change the pricing dynamic, they do change the competitive dynamic, and they do change how incumbents are thinking about you know, buying and selling assets.
Yeah, I mean,
Anything on Brexit, Europe? Just because I get 8 questions.
Okay. I mean, for us, Brexit it will make things complicated. On the other hand, we largely produce for the UK in the UK, a big chunk of the business, and we produce in Europe for Europe. So I think it's movement of people that's a little bit problematic because we have a very international management team. Our top 200 are probably, somebody was pointing out our top 20 even executives in the organization. We have 1 American, I think. So that just tells you it's always movement of people, but movement of people here too is let's see how that unfolds. It's just difficult to ask your executives to come to the U.S. when they might not feel so welcome. So that's the Brexit. In terms of business, I'd pick up on the Chinese thing, which I think is quite interesting because we've seen our business definitely impacted by technology in China. And the fact that the consumer has changed their habits in really the blink of an eye. And what we also see is Chinese companies connecting, becoming more vertically integrated, which is quite scary. It's quite different. They're suddenly not only distributing the products, but they're looking out and saying, well, why don't I just get it made? And I have my own brand. And when you think about they have over 1 billion consumers, being successful in China is being successful. And if you've got a business model that's very disruptive and you can make that work, then you're generating the cash to go out and actually buy other things. And we've seen competition on some of the more mundane businesses coming from Asia. So we used to just look at the regular competitive set, and we've been caught off guard a couple of times by seeing completely new players that we did not expect to even be players. So.
Yeah, we've seen continued interest from Chinese players to invest in assets that they think are strategic in the United States. One element that's a little unusual is their interest in not necessarily needing to take over entire companies, but take minority positions, 20% positions, get some board seats, and there's been increased activity of that nature. As regards Brexit, it's difficult to see exactly what the impact will be because it's obviously very unclear how it will play out. But on the highest level, it is a lot of change that's being driven in Europe through Brexit and frankly in the United States right now. And typically that change creates challenges for companies, and those challenges sometimes can be dealt with organically, but I think it will drive a lot of M&A once. And whoever figures out quickly, more quickly than the rest of the market participants, what the likely challenges will be and how it will impact all the players is likely going to be in a good position, because I think it's too early right now for most people to fully understand the implications of all these changes.
Okay. And we will come back maybe to a regulatory question, but there's a couple topics that have come up here and I had on my list as well. One topic we haven't talked about, Martin, at all, that usually comes up in these panels is what is going on in private equity? Is it growing? How's the model changing? If you wouldn't mind commenting on that, and then we'll go to another question after.
Yeah, there's a lot of dry powder. I think what has worked in the last few years, which is levered beta, riding the low cost of capital, benefiting from multiple expansion, is unlikely going to work in the future. We've set ourselves up relatively immune to that. I wouldn't say immune, but in a defensive positioning. So we looked at high unlevered returns for Blackstone. We looked at having less exposure to exit multiples. On a go-forward basis, it is a generally elevated environment from a valuation perspective, but we do think there's going to be a lot of sector rotation. Certain sectors are likely going to benefit: healthcare, BPO, building materials if the infrastructure bills come through. So some areas there will be quite interesting, and then I think a defensive multi-sector investment environment is probably the most successful. But it will be, and then there's the new core funds that some firms such as ours and others have raised, which have a longer hold period, which is attractive to limited partners, and a slightly different cost of capital. And then if you go to the sector that I focus on in technology, one of the two trends that are on a go-forward basis, because I previously really spoke about what drove the last 3 years, that are on a go-forward basis are likely going to be most impactful, are AI, and I understand there's a panel on it this afternoon, so I'm not going to go into any detail. And second, data. Data is very interesting in that it is an off-balance sheet asset that is rapidly transforming almost any industry. So I spoke to the CEO of a large consumer internet company recently and asked him about his big data initiative. And I was kind of shocked to hear what he said. He said, oh, what we're doing right now is we record every freaking thing you do on our website for everybody, because it's so cheap to record the data. So every interaction, every click you do is permanently recorded by these folks. And I said, what do you do with that? He said, nothing right now, nothing, because it's too much data. We don't have the capacity to do anything with it, but we think with AI and all these things coming up to speed, we'll eventually want to use it. And so this is an asset that's driving a lot of the thinking of folks in Silicon Valley.
Okay. I want to hit one other topic and make sure we don't lose it, just because we actually did do a slide, so we can't go, if you have the slide, we use it, but also because Avi wasn't interested, but he specializes a lot in activism, and that was a bigger topic, I think, last year than has been in the press over the last few months, but I wanted to make sure that we at least hit upon it because on a session like this, I don't think you can not speak about what activism and what that's doing to the M&A environment. So do you mind?
Yeah, of course.
doing that?
I'll make a comment before we get into the slides. When we look at these M&A volumes, 3.7, 3.8 trillion, 4 trillion, we sort of importantly measure it against the market cap, that exists at the time. And so Bruce's chart early on, actually graphed not just the volumes, but also graphed it as a percentage of overall equity market cap. And one thing important to note when you think about where we are in the cycle and whether there's more room to run in M&A, we're very long in the cycle first and foremost, but secondly, that ratio of overall M&A volume to global equity market cap against which it's measured is actually within the zone of where the median has been over the last 20 years. And so when you look at where it was in 2016, where it was in 2015, it's roughly plus minus 7%. The long-term average is about 7%. I think one of the reasons we're in an elevated M&A market is that this activist phenomenon has contributed to more deals happening. I think activists have now taken positions in companies and they have decided and realized that one of the fastest ways to catalyze an outcome is to get a company sold. On the left-hand portion of the chart, you can see that the assets under management, the AUM, that is dedicated capital against activist strategies has actually peaked a couple of years ago. It's come back. In my opinion, that's not significant or dispositive because the power of the movement was never the $150 or $200 billion of capital that was in it. The power of the activism movement was always the fact that the long-onlys and the indexers would very often throw in and support activist strategies. That, in my opinion, has not changed. I do want to disaggregate the AUM, and we'll pick this up in another slide. If you look at the roughly $150 billion that's devoted to activist strategies that you see here on the bars, and you look at just the top 5 activists, they control $80 billion of that roughly $150 billion, so over half. And I'll talk about this, in a minute. The lower right-hand chart, I think, warrants a little bit of observations and discussions as well, which is that if you really look at activist activity by size, and the slices may be a little bit hard to read, but the big slices are sizes of companies or targets that are under $1 billion. The next big slice is targets from 1 to 5 billion. And you get into these smaller slices when you get to targets that are above 5 billion or above 10 billion. So what's interesting is that the largest cap situations get a lot of the press, but a lot of the activist activity by number of situations is taking place at mid-market type companies, the 2 largest slices over there. That dynamic is totally different. There's a different set of activists that goes after those companies. There's a different level of sophistication that Steve can speak to around what happens in those situations. But the thing that we've been curious about, and let's flip to the next slide, is that
Okay.
you've got...
I always love working for Avi.
Thanks.
Okay.
Bruce and I started it.
Yeah.
Bruce was my big buddy at Goldman, over 2 decades ago. So he still gives me a lot of attitude every once in a while. But yeah, so you've got the clicker today. So on the left-hand chart, we looked at situations on the activist side just over $10 billion. So we sort of drew an arbitrary marker over there. And you can see that the size of those situations has trailed off a little bit as we were in 2016, but it's kind of come back. And our sense of it is that this has always sort of puzzled me because the largest, most sophisticated companies have always been self-correcting. They have fixed their board profile relatively quickly. They have stayed in front of activist strategies, relatively well. But yet we still see situations in which these companies are being attacked by activists and visited by activists. And so, the way I think about what's happening over here is that when you think about the AUM and the statistic I gave you earlier that the top 5 activists control over 50% of that AUM, when you get into the implications of what happens in terms of the size of bets that they need to take, therein lies the solution or the answer as to why these large companies continue to get visited by activists. So if you just take the top 3 activist positions in the top 5 activist funds, so the top 15 positions, right? They account for $40 billion of that $150 billion of AUM, right? So 15 positions, $40 billion of investment. So each position is $2 to $3 billion in size. If you wanted to take 5% or less of a company and you were taking a $2 or $3 billion position in it, by definition now you're looking at companies with market caps of $40, $50 billion plus. And I think that, what we're observing is that these larger companies are places for activists to really park significant AUM P&G and Trion's stake of $3.5 billion in P&G is, I think, just the most recent example of multi-billion-dollar depositories of capital going into these very large cap companies. And I think our sense is that because the activist funds themselves have gotten to a size of $10, $15 billion plus, they have no choice but to invest in companies where they can put 1, 2, 3, plus billion-dollar stakes. And that's going to implicate the large caps, I think, for some time to come.
Does anybody else have a? Okay.
And I have a question for you. So if we look at some of the charts we were looking at earlier, where we're talking about job creation being one of the key issues out there, and in fact, how do you talk about activism, and how do you talk about going after these large cap companies where the solution is pretty obvious?
Yeah.
The solution is let's just cut. It's all about shareholder return. You cut the jobs. That's the obvious. It's just go to zero-based budgeting, which cuts heads inevitably. And so when I look at what happened with the Unilever 3G, there's clearly another business model out there. There is a business model that says, hey, for example, the Dutch law, which says you must look at the stakeholders, not the shareholders. And how is that? To me, it looks like a collision course.
Yeah, you raise a number of really interesting points, and so I want to touch upon it in sort of the following order. Firstly, the activists haven't yet crossed that chasm. I think they are still about running these companies for efficiency, and in fact, I think they're starting to take playbooks out of the private equity business, and they're getting much more operationally involved in these companies, which ultimately leads to efficiency and job losses. One of the most recent activist situations is around CSX, and Hunter Harrison, who now is going to be the CEO. In Jacksonville, they're going to lose anywhere from 3,000 to 5,000 jobs. That's already been out there. And we have not seen yet the activists moderate their behavior on that messaging or the implications of what could come out of that. And Steve should speak to it as well. I think at some point they're going to have to, because I think it's going to become a politically charged issue. And I think if you have more and more of these situations that lead to job destructions at companies, it's going to enter the political realm, and I think the activists are going to have to be responsive to it. But to date, I think the playbook has been, if anything, full throttle and using techniques out of the private equity world to actually further optimize these companies. In fact, I think private equity and activism have sort of melded in somewhat of an interesting way. CSX is one example of where a industry iconic character was brought in, combined with an activist to do something and force some change. But if you look at what happened to Tiffany very recently, just in the last month, with Jana and Francesco Trapani, that's yet another example of it. In the energy space, we had a smaller company called NRG, which is an independent power producer, but an incredibly high-profile industry veteran. John Wilder, the former CEO of TXU, joined with Elliott to come after NRG. I think this is a trend that we're seeing, and so the activists really have shown no sensitivity yet to this issue.
Whereas, just to speak to the similarity or dissimilarity to private equity, we've done a lot of studies on the companies we invested in, and we're net job creators as private equity investors, and we have lots of empirical data to back that up. In activism, I don't know enough about the various things activists push for to empirically know what the impact on jobs are. Certainly there's sometimes cost reduction, but quite often we see M&A driving companies to divest certain subsidiaries, etc. And I would echo your comment that sometimes companies are run inefficiently, and public company boards were not very effective in changing that in the past, and that created an opportunity for private equity funds. To the degrees the activists do that without paying a control premium, it reduces the opportunity set for private equity firms such as ours somewhat. So that's a trend we're certainly seeing.
Yeah, I'd make I'd make a few points. I don't know if folks saw last week that Bill Ackman apologized for losing $4 billion on Valiant, and I'm sure there were a handful of CEOs who were chuckling and around Bill's misfortune. The fact is that there are very few truly novel ideas that are coming from the activists. Activists have a playbook. It's basically coming down to governance, management, capital allocation, structural operation. That's pretty much it, okay? And I think that the trend has forced companies, all of our clients, to look at themselves and get ahead of the activists. And so the fact is, for a lot of these large caps, Goldman and Deutsche Bank go around the country and around the world advising boards on, hey, get ahead of this. Look at yourself through the eyes of an activist and do it before somebody does it to you. And I think you're seeing a lot of that. Companies divesting, spin-offs, separations, acquisitions, things like that. And so the activists have to sort of find a different playbook. And so now you have activists trying to replace CEOs. You have the CSX example, where it's more than just their standard playbook. I think the issue of jobs is really quite an interesting one, PR, political standpoint, because an activist is going to force CSX to fire 5,000 people. Well, at what point does an activist defense and the politics of the Trump administration merge, and in effect, sort of using that as a defense? That you really want me to lay off 10,000 people in coal country? Is that what you really want me to do, Mr. Activist? By the way, they're all male, just as an aside.
Yeah.
I don't think there is one female activist, okay? And I think we could probably all know why that's the case. And now you have son of activists, okay? So somebody leaves Pershing and starts Sachem. And so, there are now generations of activists, but they are truly all male. And I think, I think that they're walking into a political landmine, a minefield. And we haven't quite seen it, but I think we are going to see a defense that's going to include, hey, we're about protecting jobs, not about firing workers.
So I think, just one second, I think Valerie raised an interesting point on Unilever just being one example, but this whole concept of stakeholder versus shareholder. Mm-hmm. And one question I would love for the panelists to answer, and as we're getting closer, we may need to make them, predictions, but and there's a lot of questions here about impact on cross, nationalism, a lot of these issues on the impact on, do we view this panel, cross-border activity being negatively impacted by some of these, by politics, by some of the implications of some of the points that you raised. So, Avi, do you want to take that?
Yeah, I'll be brief. I think it's going to negatively impact cross-border activity because there's an uncertainty in the air right now. Until there is a transaction that is tested and the administration blesses it, I think people are going to be a little bit more reserved on that front.
Yeah, I would echo that.
Okay.
Yeah, I mean, I think, as I said, I think that we're sort of in a brave new world. Clients, companies are still trying to figure out how to navigate Washington, how to navigate the administration, within the administration, within the White House, how you navigate, okay? There's the Steve Bannon school, there's the Gary Cohn wing, there's the Steve Mnuchin wing. So if you're planning your next $50, $100 billion deal, okay, I think the question is going to be, do I go to the administration first, okay, the night before? And if so, who do I go to? Do I go to the Bannon wing to try to placate the right? Do I go to Gary Cohn, a former president of Goldman Sachs, who will be more aligned? Do I also go to Mnuchin to cover all my bases? I mean, these are sort of real-world issues that companies are grappling with, because it's not a monolith. As we know, there's a lot of politics within the White House right now, and trying to figure out the right place to go is critical, and I think it will be more so this year.
So what's your prediction on cross-border activity?
For me, if it's a growth story, a real growth story, and you can create value without cutting jobs, I think you've got a chance. I think if it's just about racing to the bottom, forget it. Because I just don't see how you get that across. And if you look in Europe, you look in other parts of the world. I mean, the Chinese aren't going to stand for job cutting either. I just don't think that today, until we figure out how to create new jobs in coal country, as we heard before, I just don't see how you get that across.
And I'll finish up the question with my prediction. I think that cross-border activity is going to continue. I think companies are global. We're seeing all our clients. I mean, they have to think outside their borders. I think what's going to be impacted, so I think everybody's right. I think it's the mega deals where you're going to see kind of a reduced amount of activity over the next year or so until people figure this out. But regular kind of the sub $10 billion stuff, I think will, if anything, I think will increase. People will figure out taxes, but I think strategically, cross-border activity just continues to make a lot of sense for technology reasons, capability, growth of consumer, not enough growth in domestic markets, you know, et cetera, et cetera. So I'm bullish on cross-border, not bullish on mega deals right now, which is why I predicted that there'd be a slight downward tick in M&A activity, which leads us to our last 3 minutes, and kind of like the McLaughlin Group, we're going to do the exit question. If each person could just comment a little bit, what do you think is going to be the most innovative or the biggest or most interesting thing that's going to happen in M&A over the next 3 to 5 years? Someone said you said there's no innovation in activism, but where do you think the innovation, where do you think activity is leading in M&A over the next 3 years? What's the most interesting thing you want to talk about? Who wants to start?
I'll throw it out. I'm fascinated by Twitter because it is ubiquitous, and it's, President Trump was bragging, I think it was in the FT a few days ago, that he has 100 million followers, and why do I need the press? And yet, they can't quite figure out how to make the business model work. So as a tool, as a medium, it's this amazing tool, and yet as a company, when you compare it to Facebook, LinkedIn, Snapchat, my kids will not let me be on Snapchat. I'm on Facebook, I'm on LinkedIn, I'm on Twitter. They won't let me follow them on Snapchat. But Facebook is, it's one of these companies that, prediction, it will be taken over either by a very smart PE firm or perhaps a foreign bidder who could not run it for the quarterly earnings, but really as a communications tool. So there's my one prediction. I'm sure I'll be wrong.
Yeah, me, it's more of a question than a prediction. And consumers are changing the way that they look at companies, the way that they shop, the way that they connect with their friends. How does that work? Where does that go? And it's a big question. Technology is a big part of it.
Okay.
So 2 thoughts. One is that we have lived in an M&A wave where we have narrowed and focused companies almost to the nth degree. We have divested divisions that don't make sense. We've spun off things that were adjacent to businesses, and companies have gotten very narrow in their focus, and investors have wanted that. And I think corporate boards and management teams have responded. So, one prediction or question would be, does that continue? Has that gone too far? If you look at how the rest of the world is organized, they're still in a much more conglomerate mode. And they're building conglomerates, whereas many of the companies over here have streamlined. So that's kind of one observation. The other is that the recent IPO of Snap raises an interesting question. We've taken a company public where the founders have 90% voting control. It's a public company. It's taken public capital, but the clear mandate has been that you shareholders that have given us capital will not have a say in the governance and the running of this company. There is a thesis developing in Silicon Valley that kind of a governance paradigm is actually good. It allows for longer-term investment. It allows sort of the opposite of what sometimes activists do, which is to narrow the time frame of adjudication of results. And this thesis is developing that this is a good governance paradigm. So my question going forward would be, does that continue? Does that have traction broader than just the highest growth Silicon Valley companies? Because it speaks to a lot of the issues that we talked about, and you can't have, in my opinion, in public companies, stakeholder capitalism unless the index funds get on board with it. And so if they don't show leadership on that position in the next couple of years, I don't think we'll see it.
So Martin's going to take us home.
Oh, no. Well, I think the more things change, the more they stay the same. So to some degree, I'm not a believer that there is a new normal or a massive the transformative trend to M&A. The things that have driven M&A historically are likely going to drive it in the future. If I were to think of one thing that is going to be important over the next 5 years, I'm going to repeat the comment I made earlier, which is that data is a hugely valuable asset. AI will be the biggest tech trend, and data is the fuel that feeds the AI. So that's going to be something that people will increasingly look for as they acquire companies. And it's an off-balance sheet asset that is underestimated.
That's it. Thank you, everybody.